what is leverage? What is the meaning of leverage? Leverage, as I mentioned little while ago, would simply mean borrowed capital. Use of borrowed capital in the business means leveraging. Now, how do we calculate the leverage ratios? Please remember, leverage ratios are also known as solvency ratio. And why these are also known as solvency ratio? These are known as solvency ratios because they give you an idea about solvency of a business, whether the business is solvent or it is not solvent, whether the business is going to run the risk of becoming insolvent going in future. Leverage ratio will give you that idea. And how will that happen? Let's understand. So the first ratio that we calculate as part of the leverage ratio is known as net gearing ratio. So net gearing ratio would mean what? Means net debt divided by shareholders equity. What is the meaning of net debt? Meaning of net debt is bank and financial borrowing, short term, medium term or long term, minus the marketable securities and the cash. So that's your net debt. So net debt is your total borrowing from the bank and the financial institutions, minus the marketable securities and minus the cash. Now this is your net debt divided by shareholders equity. Shareholders equity will mean equity share capital plus it will mean retained profit. So this is how you will calculate your net gearing ratio. So what the net gearing ratio tells you? Net gearing ratio tells you as to what is the ratio, what is the proportion in which you are using the borrowed capital and your own capital. So let's say, for example, the net debt of a company is 100 and the shareholders equity of that company is 50. That means the net gearing ratio of this company is 2. Contrary to this is one situation, all of you, and the second situation, there is another company and this company's net debt is 50 and the equity is 100 and therefore the company's net gearing ratio is 0.05. So question to all of you, which in your view is better situation 1 or situation 2? Which is more solvent? Company A, company 1 or company 2? All of you. Second, right? Okay. Situation 2, right? So why this is more solvent? Because the equity is more, right? So equity is more, and that means this is a safer company, and this is an unsafe company. And why unsafe company? Because borrowed capital is double of the equity, and that is why this is unsafe company. So that is number one, what you calculate the net gearing ratio. The second ratio that you calculate for the purpose of leverage is net debt to EBITDA ratio. Net debt to EBITDA ratio. And how do we calculate net debt, which is same as you have seen it here. So, and current EBITDA, and I'm sure you will remember how to calculate the EBITDA. EBITDA is COI, if you can remember, COI plus depreciation and plus amortization. So that is your EBITDA, earning before interest, tax and depreciation. So this is how you calculate your net debt to EBITDA. What does it tell you? Okay, so let's take an example here once again. So there is a company 1 and there is a company 2. The company's net debt is 100 and company 2 also net debt is also 100. But the current EBITDA of company 1 is 500 and EBITDA of second company is just 100. Which is a better company? Everyone.
First one.
The first one, right? First one. Why? Because in case of first one, company is generating cash flow which is 5 times of the net debt, and whereas in case of company 2, a company is generating net EBITDA which is just equal to the net debt. And this is how you will figure out your leverage ratio. Now, so having understood as to what is liquidity ratio,